Hey, everybody, it is almost the end of 2023, and I don't know about you, I'm going to be doing some shopping in the stock market before the end of this year. Before we get into what we are buying, Tyler Crowe is joining me. Please take a minute to click on the link you see on your screen right now. You get a message from our sponsor, The Motley Fool, and get the top 10 stocks to buy right now. All right, so before the end of 2024, as everyone knows, or before the end of 2023, rather, as everybody knows, I like the real estate sector. I'm a big real estate investment trust fan. I've talked about many of them on the show before. Realty Income is one of my largest stock holdings. I own Vici Properties and a bunch of other ones that I've bought recently. But at the same time, real estate has been one of the worst performing parts of the stock market in 2023. And most of it has to do with interest rates and cost of capital concerns and things like that, not the businesses themselves. But I don't really want to buy one single REIT other than the ones I already own. I'm going to buy all of them. I'm going to invest in the Vanguard Real Estate ETF, which might surprise some people that I don't own already because I already own, and the reason is I already own like 10 other real estate stocks. Ticker symbol is the VNQ. It's a Vanguard Real Estate ETF. They own a bunch of stocks, kind of a bunch of real estate stocks in proportion to their market cap. So the bigger ones have bigger weighting. And there's a few reasons I want to buy. Number one, it's a very low cost way to get exposure to a broad portfolio of real estate. 0.12% expense ratio is very low, even by index fund standards. The real estate sector is still 23% off the highs. You might have heard that the Dow Jones just hit a new all time high. Real estate's still down by 23% from its 2021 peak. Because it's down and real estate tends to be high yielding stocks, the VNQ has a 4% dividend yield, which is very nice historically for this ETF. And the big reason is because it's weighted toward a lot of the worst performing REITs are the biggest ones. So it's weighted towards the ones that have been beaten down the most, specifically companies like Prologis, American Tower, Crown Castle, Equinix, Welltower. These are the top five positions of the REIT. And they're all companies I would kind of like to own, but don't really want to try to pick a winner out of them. I just think all of them are just generally undervalued right now. So it allows me to buy all of them in one investment. So the VNQ is a stock that I should have added to my portfolio a while ago, but I'm going to make up for lost time and do it today. Well, not today. I have to wait a few days after we record this before I can buy it. But before the end of 2023, I'm going to add some shares of VNQ to my portfolio. Tyler has a much more interesting company to talk about, I believe. And it's one that he kind of gave me a one sentence description, and I'm already interested. So, Tyler, what are you thinking about buying before the end of the year?
So I'm going tangential to the real estate uh, business, and I'm going towards title insurance. So for those of you who don't know, when you buy a home, you also get title insurance. Basically, an insurance contract that says, we're going to do the due diligence that says, when you buy this house, you are the rightful owner, you have the deed, there are no outstanding claims against it, like, a construction lien or a tax lien or anything like that. And if there is, and we didn't find it, we're going to pay it out. It's a typical insurance contract. So the company I'm going to mention is an investors title company, ticker ITIC. It is a very, very small company by stock investing standards. It's only $300 million company, but it's been around for 50 years. It was founded in 1972. Its CEO is still in place, the same guy. He's 88 years old. He's just still kicking and still running this business, and with his two young whippersnapper sons that are in their 60s. And it's a business that is like just absolutely rooted in conservatism. When we think of like insurance companies, we think like Geico and like, oh, you get to use the float to invest in stocks like Warren Buffett does. No, they invest in treasuries. They invest in debt. It's a very, very conservative like float that they have on their business. So, it's never going to be this business like, they don't aspire to be a Warren Buffett, but at current yields on treasuries, that's a good business right now. 5% on treasuries on your float. That's good. The thing that's interesting to me about this right now is that the housing market's been in the dumps lately. Like sales have been awful. And so their core business of investing in underwriting has stunk. And yet it's still producing good returns because the interest gains on its float have been able to kind of offset all that decline on it. And so if we do happen to see a decline in interest rates, we're going to likely see an uptick in title insurance underwriting. So you have that that kind of, we'll call it the catalyst that could actually make this company grow a lot or grow modestly, because let's face it, this company has never been one to go to the moon considering how small it is. But if it doesn't, you have that protection of a float that is very conservatively run and throws off enough interest income that you're not going to get wiped out, and it's pretty much debt free. So everything like that makes it look attractive. They pay a modest dividend, but they also pay a special dividend because the founders own a significant portion of the company, and so they use the special quarterly and special dividends as kind of the payout that they get. Now, I have to say this, because the company is so small and it is so thinly traded. I think it only trades about like 2,000 shares a day. And so like maybe $500,000 worth of goes back and forth in any single day. That's very, very small by stock standards. If anyone is ever considering something this small, not just Investors Title, but any company in this size, you want to use a thing called limit orders. It's basically saying you set a price that you want to pay for this stock, and however long you want that particular order to be filled, you kind of set the time and say, don't buy it at any indiscriminate price, because if you try to buy a large chunk at such a thinly traded company, the stock can go very, very high for a day or two while you're actually accumulating position, and could significantly change kind of the returns that you get. So kind of a general lesson for people who are looking at smaller cap companies: really pay attention to things like volume and float, to know, like, not to just kind of go hit the buy button like you may with a giant company like Apple.
Definitely a good point. One more time, what is the ticker symbol for that one that you mentioned?
Yeah, Investors Title Company, ticker is ITIC.
I am going to be looking into that one a little bit more. And you make a great point when it comes to small caps. I own a few that are very thinly traded and have pretty big spreads between even the bid and ask price. So what you're seeing on your quote, if you just get a quick quote, might not be the price that you could actually buy it at. So limit orders become very important in those situations. I generally use market orders if I'm buying a stock like, Bank of America. But when it comes to the smaller caps, it does make a big difference in a lot of cases. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.